Happy day. This is Dr. Nirupama from PG Program in Commerce, M.O.P. Vaishnav. So today let us discuss on the topic charts in technical analysis. So here comes the fundamental analysis and the technical analysis in order to support the investors as well as the traders to come up with their investment decision. Fundamental analysis is based on the intrinsic value of the shares, whereas technical analysis makes use of charts. Technical analysis, we could say, is an art of reading past and predicting the future. So this technical analysis is nothing but is an analysis using the charts in order to predict the future movement of the price of the securities. So what exactly we mean by charts? Charts are nothing but simple presentation or a graphical representation of the price of the securities over a period of time frame. So these charts are being made use of in order to come up with an investment decision. These charts have the strength of condensing information into a pattern which is very easy to understand, and it also provides a framework to analyze the position of the market. So the technical analysts make use of different types of charts, which includes a line chart, a bar chart, a point and figure chart, and a candlestick chart. So line charts. What are line charts? Line charts are the most commonly used and the simple form of charts which are used in finance. These are the charts which are being constructed taking into consideration the closing price of the securities over a period of time. It takes into consideration only the closing price of the securities because the closing prices are considered to be more important compared to the open and the high prices of the particular day of a security. Line charts are simple in form and easy to understand. It displays information as a series of data points connected by straight line segments. It is a way of visually representing an asset's price history using a single continuous line. Moreover, these line charts reduce noise from less critical times in the trading day. Then comes the bar charts. These bar charts are made up of a series of vertical bars. These bars come up with three interesting information. Firstly, the highest and the lowest price of a stock during the trading day. Secondly, the close and the open price of the security during that day, and lastly, it indicates the volatility of the security during that particular trading day. So in case of a bar chart, the top and the bottom, it denotes the highest and lowest price of the securities, whereas the projections, what we have it towards the side of the bar, it indicates the open and the close price of the securities. So the length of the bar determines the volatility of the price of the securities. So higher the length, higher will be the volatility. Shorter the length of the bar, lesser will be the volatility of the security prices in the market. So these bar charts are also called as OHLC charts, which comprises of the open, high, close and the low prices, which helps the traders in order to see the patterns more easily. At the same time, these bar charts show the price of a stock, its volume over a period of time. Moving on to the combination of bar charts. So these bar charts do come up with different combination, which includes an up day, a down day, inside day and an outside day. So up day, if the high and the low of the present bar is higher than the previous bar, then it is known as an up bar or a up day. Down day, if the high and the low of the present bar is lower than the previous bar, it is termed as a down day, which denotes that there is a bearish consequence. Then comes the inside day. So if the high of the present bar is lower than the previous bar, high and the low of the present bar is higher than the low of the previous bar, then it is termed as inside day. Here comes the outside day. If the high of the present bar is higher than the previous bar, while the low of the present bar is lower than the previous bar, it is termed as an outside day. These are the different combinations when it comes to a bar chart, based on which we could come to an conclusion. Point and figure chart. These point and figure charts were popular in US in the early 1900s. So these charts reflect the price movement without time as well as volume concerns. So back then, the investors didn't have any sophisticated tools or mechanism or even computers in order to come up with the construction of charts. As a result, they need to come up with a different methodology. So here comes the concept of a point and figure chart. So these are the charts on a dimensional without any indication of time and volume, which show the price changes in relation to the previous prices. Point and figure chart consists of a series of X and O's, are what we could call it as zeros. So X represents an upward price trend, or we could say a price advancement, and the zeros are the O's represent a downward price trend, what we call it as a price retracement. So the prices are given to the left of the figure, and the price can change in intervals of 1, 2, 3, 5 and 10 points. So at the starting point, an X is placed and another X is placed if the price increases by 1 point, and if the price decreases by 1 more point, a 0 is placed in the next column. Like that, X and zeros are placed depending on the advancement or the decline of the prices over a period of time. So this chart helps in spotting the trend and the trend reversal at a given point of time. So here comes the most popular type of chart which is being commonly used, and it was being used in Japan long time ago. So the candlestick chart. A candlestick chart is a style of a bar chart which is being used primarily in order to describe the price movement of a security, derivative, currency for a designated span of time. So it is a combination of a line chart and a bar chart. Each bar represents the range of price movement over a given time interval. So it includes the high, low, open, close price of a security for a single day. It contains two parts. So one, you call it as a real body. So the hollow or the fill portion of this candlestick, we call it as a body or the real body. The long thin lines that are projecting above and below the real body, we call it as wicks, or we call it as a shadow. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. If the stock closes higher than its opening price, then a hollow stick candle is drawn with the bottom of the body representing the open price and the top of the body representing the closing price. So depending on the advancement and the decline in the price of the securities, we do have the candlesticks in different colors like green and red. So these are the different patterns that are being taken up by a candlestick chart. So depending on the movement of the prices, it may take up the form of a morning star, a shooting star, a hammer, a hanging man, or 3 red cows, or 3 white soldiers, or it might be a bearish fake out, or it might be a bullish engulfing star. Then comes the chart patterns. So these are the major types of charts which we discussed on. These 4 different types of chart takes up different patterns which could be put under 2 major heads. One, we call it as the reversal pattern. The other one, you call it as the continuous pattern. So by reversal pattern, we mean the price exhibits up and down trends, and the trend reverses its direction after a specified period of time. Whereas in case of a continuous pattern, it confirms the movement of the market, and it suggests that the market is passing for a while and the same trend is likely to continue after a period of time. This is what we call it as a continuous pattern. So when we have the reversal and continuous pattern, we do come up with different styles of charts. So these are the different reversal and continuous pattern which a candlestick chart will take up. It may take up a double top, a head and shoulder pattern, or a rising wedge, a double bottom, inverse head and shoulder, a falling wedge. In under continuous pattern, it may take up the pattern of a falling wedge or a rising wedge, a bullish or a bearish rectangle, a bullish pennant, or it might be a bearish pennant. It might even take up bilateral patterns where we have ascending triangle, descending triangle, and symmetrical triangles. So when we say a double top, so there will be an uptrend followed by a downtrend, again there will be an uptrend followed by a downtrend. So when the same pattern occurs reverse, then we call it as a double bottom. Similarly, when it comes to a head and shoulder pattern, there will be an uptrend, upward movement of the price followed by a downward movement. Again there will be an upward movement of the price of the securities. So the second upward movement will be slightly higher than that of the first movement, and there will be a fall in the price of the security. Again there will be a upward movement. So the third upward will be somewhat similar to that of the first uptrend, so forming a head and shoulder pattern. So that's why it's called a head and shoulder pattern. So these are the different continuous as well as the reversal patterns that are being taken up by the charts. So based on these types of the patterns, the investors as well as the traders, they can come up with their investment decision when they want to invest their money in the securities. Thank you.